Summary of The Intelligent Investor, written by Benjamin Graham, summarized by Detailed Book Summaries. Don't forget to subscribe. And if you are a returning subscriber, you are welcome. Chapter 1: The Philosophy of Intelligent Investing. Benjamin Graham begins his masterpiece with a timeless truth: that investing is not about gambling on what will happen tomorrow, but about protecting and growing one's wealth over the long term through sound thinking. He differentiates between two types of people in the financial world: the speculator and the investor. The speculator focuses on price movements, market trends, and quick gains. The investor, however, focuses on intrinsic value, the real worth of a company based on its assets, earnings, and future potential. Graham insists that an intelligent investor is not necessarily a genius, but someone who possesses patience, discipline, and emotional control. He introduces the concept of Mr. Market, a fictional character representing the stock market's emotional nature. Mr. Market comes to you every day offering to buy or sell shares at different prices, sometimes enthusiastic and overconfident, sometimes fearful and pessimistic. The intelligent investor doesn't get swayed by Mr. Market's moods. Instead, he uses those emotional fluctuations to his advantage, buying when prices are irrationally low and selling when they are irrationally high. This metaphor forms the philosophical heart of the book. Be rational when others are emotional, and be cautious when others are greedy. Graham also stresses the importance of margin of safety, the idea that every investment should include a buffer against potential losses. Just as engineers build bridges to carry much more weight than they expect, investors should buy stocks at a price significantly below their estimated value. This principle protects investors from human error, market volatility, and unforeseen risks. In this opening chapter, Graham sets the stage for a way of thinking that values logic over emotion, patience over haste, and safety over speculation. Chapter 2: The Defensive and Enterprising Investor. Graham divides investors into two main types: the defensive investor and the enterprising investor. The defensive investor seeks stability, consistency, and minimal effort, while the enterprising investor is more proactive, willing to devote time and research to seek slightly higher returns. Both can be successful, but each must follow disciplined principles. For the defensive investor, Graham advises a balanced portfolio of stocks and bonds, typically split 50-50. Stocks provide growth potential, while bonds offer stability and income. He warns against putting too much faith in market forecasts or short-term predictions, emphasizing that even professionals can't consistently time the market. Instead, the defensive investor should focus on broad diversification, low-cost funds, and regular rebalancing to maintain the desired asset allocation. The enterprising investor, on the other hand, is encouraged to take a more hands-on approach. Graham suggests focusing on undervalued companies, neglected industries, or special situations, such as mergers or reorganizations, that the market has overlooked. However, he cautions that this approach demands deep analysis, patience, and constant vigilance. The enterprising investor must treat investing as a business, not a hobby. He must think independently and resist following the crowd. Graham's brilliance lies in showing that either path, defensive or enterprising, can work if followed intelligently. What matters most is not the method chosen, but the mindset applied. The key is consistency, humility, and the willingness to learn continuously from one's mistakes. Chapter 3: Understanding Market Behavior. In this chapter, Graham delves deeper into market psychology, the invisible force that drives prices up and down. He observes that markets are not always rational. They are swayed by fear, greed, and human emotion. Prices can swing wildly, not because the underlying businesses have changed, but because investors' perceptions have. Understanding this is critical to becoming an intelligent investor. Graham uses the Mr. Market parable again to emphasize that stock prices are quotations, not commandments. The market exists to serve you, not instruct you. When the market is euphoric, it offers overpriced shares, a time to be cautious. When it's depressed, it offers bargains, a time to act. Successful investors like Warren Buffett took this lesson to heart, often repeating Graham's principle: be fearful when others are greedy, and greedy when others are fearful. He also introduces the concept of value investing, the practice of buying stocks for less than their intrinsic value. This requires careful analysis of a company's financial statements, earnings history, debt levels, and management quality. Graham insists that value investors are not pessimists. They are realists who prefer to buy $1 worth of value for 50 cents. Over time, the market tends to correct its mistakes, rewarding those who have the patience to wait. Furthermore, Graham warns against following the herd or getting caught in speculative bubbles. Whether it's the dot-com mania of the late 1990s or cryptocurrency frenzies of the modern day, his lessons remain timeless. Investors lose most when they forget that markets can behave irrationally for long periods. The intelligent investor must stay grounded in data, logic, and long-term thinking. Chapter 4: Financial Analysis and Margin of Safety. Here, Graham turns from philosophy to practice. He explains how investors can analyze a company's true worth by studying its earnings, dividends, assets, and financial strength. He encourages investors to look for consistent performance over many years rather than short bursts of success. A good company, he argues, is one that shows steady growth, prudent management, and a history of rewarding shareholders. Central to this chapter is the margin of safety, perhaps the most famous concept from Graham's work. The idea is simple but profound. Never pay the full price for an asset's calculated value. Instead, buy it at a discount that provides a cushion against errors in judgment, economic downturns, or unexpected events. This approach turns investing from speculation into a form of risk management. For example, if a company's estimated intrinsic value is $100 per share, the intelligent investor might only buy if it's priced below $70 or $80. This difference, the margin of safety, protects the investor even if the valuation proves slightly optimistic. Graham likens this to crossing a bridge that can hold 10 tons, but only driving a 5-ton truck across it. The concept has become the cornerstone of value investing, adopted by legends like Buffett, Charlie Munger, and Seth Klarman. Graham also stresses the importance of financial discipline, avoiding excessive debt, diversifying investments, and resisting emotional decisions. He urges investors to view each stock as a partial ownership of a real business, not just a piece of paper that fluctuates daily. By grounding decisions in analysis rather than emotion, investors can create a portfolio that endures market storms and grows steadily over time. Chapter 5: The Intelligent Investor's Mindset. In the final chapter, Graham circles back to the essence of intelligence in investing, the mastery of temperament. He argues that the greatest enemy of the investor is not the market, but himself. Emotions such as fear, greed, impatience, and overconfidence can destroy even the best investment strategy. The intelligent investor, therefore, must cultivate mental discipline, the ability to stay calm during market booms and brave during market crashes. Graham insists that success in investing doesn't come from predicting the future or outsmarting others. It comes from self-control, long-term perspective, and adherence to sound principles. He encourages investors to focus on what they can control: their analysis, their patience, and their behavior, rather than on market fluctuations or economic headlines. He concludes that investing is not a race or a gamble, but a lifelong journey of learning. The intelligent investor is one who treats every mistake as a lesson, every success as validation of discipline, and every market cycle as a test of patience. Wealth, in Graham's view, is not merely financial. It's intellectual and emotional maturity. The intelligent investor is not a get-rich-quick guide. It is a manual for building lasting wealth through rationality and discipline. Benjamin Graham's teachings remain as relevant today as they were when first published in 1949. His core message echoes through every era. The key to successful investing is not brilliance, but character. By learning to think independently, applying the margin of safety, understanding market psychology, and maintaining emotional stability, anyone, regardless of experience, can become an intelligent investor. This book stands not just as a guide to finance, but as a philosophy for life. Stay rational when the world is emotional, and you will always find opportunity in chaos.